Hey guys, what is up? It's your boy Vijalarazzi, and today we are getting into my Beginner's Guide to Cryptocurrency series Part 3, How to Trade Chart Patterns. So, if you haven't watched my other two videos, I highly recommend that you go back and watch those. If you're a newbie trying to get in to learn how to trade, then it's really going to benefit you, and there's some really quality content on there for you to check out. So go back and watch those other videos. Alright, so why chart patterns? Well, number one, they provide profitable trade setups. Number two, they're easy to spot with a trained eye. And number three, they work on all time frames. Now, after I show you how to spot them out a little bit, it's going to be easier for you to go back and back test and kind of give you a little blueprint to follow up on. I know that it was kind of difficult for me to first find these little chart patterns, but once I went back and started really looking for myself, it became easier and easier. So I'm hoping by the end of this video, you guys will have a little bit of a better understanding in how to actually trade some of these. So what you're going to learn is what are chart patterns, how to identify chart patterns, my favorite patterns in crypto, how to apply them to your trading plan. Now, there's three groups of patterns that you have to consider. These are like the three main groups that most patterns can fit into. So you have reversal patterns, continuation patterns, and bilateral patterns. And bilateral patterns mean they go both ways. So we're going to cover quite a few different patterns today to help you kind of get a little bit of a better understanding of what exactly I'm talking about. So here's some examples. These are going to be some of the patterns we're going to cover in today's lesson. Some reversal patterns, double top, head and shoulders, rising wedges. Continuation patterns, we got wedges, flags, pennants, and then bilateral we have ascending triangle, descending triangle, and even some symmetrical triangles. So these are some examples of things, and we'll cover some of these patterns today to kind of give you a little bit better idea. But I'm going to transition to my screen and we'll get right into this. Okay, so I'm at my screen here. Now, it's important to understand where a chart pattern it comes from and how it's actually formed. So the best way I like to look at this is markets are 100% human emotional psychology. So what that means is that you have humans that are predominantly trading these markets. They buy and sell and they dictate where the price goes. So with that thought, it's important to understand that humans are emotional creatures as well. And when we trade these markets, the human emotions really come out of us. The patterns kind of arise due to the fact that humans continue to trade these markets the same way, where you start to see these patterns arise that have certain probabilities to go one way or the other. Now, these patterns always arise, and you can find them on every time frame. Humans are always going to be trading these markets, and it's going to cause these patterns to form again and again. Knowing how to trade them is going to be very key to your trading practices, and it's going to help you because it gives you another indicator to base your strategy on. Now, for this video, we're going to start by going into and looking at some reversal patterns. So I have Bitcoin up, and this is the daily chart, and we're going back to 2013, 2015, in that area, forgive me. So to start, I wanted to point out a trading pattern that was one of the first ones that I ever learned, and this is called the double bottom or the double top. The thing about chart patterns is you're going to be able to find them in both bullish and bearish markets. It's universal, so you're going to be able to find them no matter what, and they come up with pretty great frequency. So if we come into here, what is a reversal pattern? Well, a reversal pattern is something that happens at the very end of a correction, or is the telltale move that the market is starting to turn around in the opposite direction. So if we come here, we can see that Bitcoin had this great big rally. Now, the point of correction is over here. So if we zoom into here, we can see a pattern arise. Now, this pattern is called a double top. We have price rally and hits this point of resistance and then falls, and then it goes back up and then hits that same point of resistance again and then falls once more. Now, this second peak is showing that the buyers don't have enough momentum to push the prices any further. And the way that you look to see if this is actually a valid pattern is when it breaks the neckline. And the neckline is going to be that point of resistance where the top acted as support. So you have it tops out here, lands on support here, and then it tops out again, and then it breaks through that support. So right down here, we can see a clear candle break of the neckline, and that's where you wanted to start taking your short positions. So this is a pattern that happens quite often inside of crypto that I see it. This is always good because it can help you get out of a market. I showed you trend lines in the other video, and so this is sort of another indicator to use ahead of whatever else you're using in your trading plan. In a bearish market, you have a reversal from the same pattern. So we're going to go look down here and see if we can find a double bottom formation. Okay, so this is the point of, this was the lowest low that we had, right down here. This was the final sell-off and it shook everybody out. This is capitulation in the market. And then prices kind of rally. This would be the first bottom. We have this big round. Prices go up. And then it gets rejected right here. And I'll mark this because it's important to know. Okay. And then price falls one more time. But it doesn't break below. It manages to maintain support. And this is the second sell-off. But it doesn't manage to break below this one. And then the price rounds out. So it capitulates, and then it starts the double bottom formation. Now this double bottom is going to look a little bit different from the double top up here, and that's mainly because in a bull market, prices are getting squeezed a lot tighter than at the bottom of a bear market. You generally see a lot of rounding and accumulation, where this is just a bubble that's popping, and there's really not a bunch of support below it, so it really starts to fall. So here we go. This was an example of the double bottom. Now, at the end of a bearish market, and it starts to reverse back to the bulls, you will see this accumulation rounding. And this is kind of like a rounded bottom formation. It's one of the most profitable ones that I have found, and it happens quite frequently at the very end of corrections. Now, if you were trying to trade this double bottom formation, you would draw a neckline just the same as the double top. Remember that price formed this point, this lower high here, and then we have one here. Now, we're waiting for that to be broken. So, once prices break out of these two lows, or these two lower highs, that signals that the reverse is going to happen. So, what we see shortly after this is the second round, we have an immediately rise, and price rallies up. And then it breaks through this neckline barrier that we had at resistance. So, what do we see shortly after? We see price retrace and fall back onto support of that neckline. Now, if price would have fallen below this neckline, then that would have been an invalid double bottom formation, and then you would have stopped trading it there. Now, what happened is price landed on support and then started rising again. This is a confirmed reversal out of the double bottom formation. What you have after this reversal, it then comes into a continuation pattern. Now this is a pattern that we're going to talk about, and this is actually a bilateral pattern. Now bilateral patterns meaning they can go both ways. So if we draw this here, this is what you call an ascending triangle. Now the ascending triangle pattern can go both ways. It can fall out of this and then you trade it that way, or you trade the breakout. Now the best way and the highest probabilities, and what most people do when trading the ascending triangle, is they wait for it to break this neckline. Now the neckline in the ascending triangle is just the top resistance level. And once prices break here and land back on support of the previous resistance, that's when you'd want to be taking your entries. Say prices couldn't rally and then it fell through. Once prices broke out of this trending support here, that's when you would have either wanted to catch the bounce up to here where it retests and short the market there. But either way, you're going to get the same sort of returns. Now, the way to trade this is the length of the first move is usually your target in the second move. So yeah, your target's about the same as the previous move. And that's how you're going to kind of trade this. This is a bilateral pattern, but it generally happens more often in a bullish market. So it's more of a continuation pattern from what I have actually seen. So let's keep looking into here. Let's look for one more reversal pattern that I want to show you. This is one of my favorites because it's actually really easy to see compared to some other ones. So this is a head and shoulders formation. And this is actually the inverse head and shoulders because it's coming at the terminal end of a bearish correction. Now, these can happen at the top of markets just the same as you see them here, except they're going to be inverted the opposite way of this. So here we have a left shoulder, a head, and then a right shoulder. And the more symmetrical the patterns, the higher probabilities that they're going to actually pull through and succeed in the way that you think they will. So you want the shoulders to be relatively even. Now, how do we trade this pattern? How do we know if it's going to be valid or not? We come over here and we draw the neckline. It's always about the neckline with these trading patterns, because that's the only way you're going to know whether they're successful or not. So if we come here, if we were trading this, we would be watching for the neckline of resistance. Once prices were able to break out of that, that's when you'd be starting to take those buying actions. Now, sometimes prices will retrace back to that resistance zone, which is why you'd usually want to be watching it on a shorter time frame to catch that. Otherwise, you're going to miss it and it's going to rally on past without you. So this was an example of one of those patterns. This is an inverse head and shoulder pattern. This is a reversal pattern. What happens as soon as we see this pattern? Well, price reverses and goes on another big bull run and a rally. So this one's fun. I'll just show you the whole sequence here. So price rallies, and then we have this correction. At the bottom of the correction, we have another inverse head and shoulder. We have the left shoulder, the head, and then the right shoulder. And then prices break out of that neckline and line on support. And then what happens? Price goes on to rally. And then what happens right here? We have the same pattern, however, this one forms at the end of a major bull run. So here's the left shoulder, here's the head, and then here's the right shoulder. Now we come through here and mark the neckline, which would be there. And we see price breaks through the neckline right here. And then we see this big bullpen candle to come up to retest that. And that's when you would have wanted to start taking your selling actions, because you know the price is about to reverse because of this chart pattern that arose. Now keep in mind, chart patterns aren't always going to come true exactly how you think they will. There's going to be instances where they just don't seem to reverse like you thought they would, or they don't come all the way down and break the neckline and then they rise again and rally. And that's what's going to happen. Not every pattern is perfect, but there are a certain set of probabilities inside of each pattern that they will go up. And so if you have your risk to reward ratio set right, then you're going to be winning no matter what. Say one doesn't go your way, you're only going to be risking a small amount of your portfolio per trade, to where it's not necessarily going to hurt you that much. Okay, so that was reversal patterns. Now, how about we get into some continuation patterns? Now, the continuation pattern are going to be wedges. These are the ones we're going to look into. Are wedges and flags along with some pennants. This is actually a good example of a falling wedge that happened inside of Bitcoin. In my examples chart that I had in the intro, that was actually an example of Bitcoin in a falling wedge. So these falling wedges, these show a reversal or a continuation. Generally with the reversal patterns inside of falling wedges, it'll come after a really big rally that happens. And then prices take a lot of time to oscillate in this falling wedge triangle pattern and descend all the way. And then once price breaks through, you'll have a large volume spike, and then prices will break out of that descending resistance, and then it'll reverse on the upside. In this case, we had a falling wedge. It broke out, it went into a double bottom formation, and then it started reversing on out of here. So this is why patterns can be important, is because you can actually combine your patterns and help kind of like tell the story a little bit better, because every market is just trying to tell a story. So this is an example of a falling wedge that happened. This is a continuation pattern, and it's also a reversal pattern. In this case, this was a reversal that happened. Now, we're going to go look at some other examples of this wedge that happened. So this is an example. That other one was an example of a falling wedge. Some of these are actually going to be examples of rising wedges. So we have here. So price comes up and it kind of goes in this triangular channel. And then once prices break out of that, that's when you'd want to be shorting. You'd want to be shorting as soon as prices break out of this support, diagonal support zone. And so this is an example of a continuation pattern. In this case, we were in a bearish cycle, so this was a bearish continuation pattern. And we see it happen quite often. Like even right here, you could count this as one. And this is even a little bit more defined than the last one I just showed you. So this was another rising wedge that happened. Remember, I just showed you a falling wedge, and in a bullish market, when the prices are falling from all-time highs, it'll be in a falling wedge. When prices are already falling and you have these little bull runs in the middle, these are rising wedges. Now, not all of them are going to be rising wedges, but these are some examples of some of those. So that just shows you how a wedge can be a reversal pattern, and it can also be a continuation pattern. If it's a continuation pattern, you're going to see it following inside of the trend that's already formed. Okay, so this is an example of a continuation pattern. Now, some other continuation patterns we have are called bull flags. Now, bull flags are a little bit more rectangular, and they come similar to what I just showed you with those rising wedges, is they happen in the middle of trends, and they're just the continuation. So if we come here, we can see one forms right here. Oops, that was weird. So this would be an example of a bull flag. You have a littler one here, and this one could actually be considered a pennant. So you have flags, pennants, and wedges, and those are your three main continuation patterns. Now, pennant is going to move more of a triangle like this. And then if we come in here, so pennants will move more of like a triangle. And a flag is going to move more rectangular. They can move at more of a downtrend, so kind of like this. And that's fine. They can move either two of those ways. However, they're going to sit here and they're going to kind of just oscillate like this, back and forth. And then they break out. And when they break out, that's when you want to be taking your buying or selling actions, when they either break out or break down. So with these patterns, you're generally trading breakouts. You can get in earlier if it's a well-defined pattern, but for the most part, people generally trade the breakouts or breakdowns. So here we have an example of a pennant, and this one moves in a little bit more of a triangular shape. This would be an example of a flag, and this happens on the support of the pennant, which shows a breakout, which a lot of times happens. After a breakout of a certain pattern, a lot of times bull flags will be formed for the continuation of the trend to come. So if we come here, here's a little example of a head and shoulder reversal pattern. Shoulder, head, shoulder, and then once it broke the neckline, it fell all the way down here and reversed. Okay, so that would be some examples of some continuation patterns. Let's see if we can find a couple more in here. Now, here would be an example of some of the more these bull flags that are at more of an angle. So if we come in here, we're just going to count it right there. Now if we come here, we can see price was having a correction in this slight little channel here. Now this channel, once it broke, that's when you wanted to be taking your buying actions. So if we come in here, counting candlesticks, this green candle body broke out of this. And so what you'll see is sometimes you'll have rectangular bull flags that trend horizontally, and then you'll have some of these that go at a more diagonal angle. Either way, both of them are fine, and they will continue if broken out of most of the time. Not always, because you can't always count on a chart pattern to form the way you think it will. So if we come here, here's another example of one of those. They kind of comes at this little bit of an angle, and then price breaks. Let me zoom in here so it's not so hard to see. And then you see these candlesticks that are breaking out. Once the candle body closes out of these resistance zones, that's when you'd want to be taking your buying actions. Or if you were looking to short the market, if it would have broken out of this channel here, you would have started to take your short positions until next resistance. So here's some examples of some continuation patterns. These work really, really well, actually. And you can find them all the time in any sort of market because they're always going to be there. Patterns are always going to arise anytime humans are trading the markets. The best way to use these patterns would be to either buy the breakouts or the breakdowns, or if you're experienced with trading patterns, then you can actually time them, but that's when you'd really want to be using like your stop losses and things like that, so if it doesn't go the way you think it will, you're not going to get stuck in a trap. Next, we're going to move on to some bilateral patterns. It's more of an indecision pattern. It means that there's there could be a bullish sentiment or a bearish sentiment depending on which way the market's moving, but it doesn't necessarily always mean that the market will continue in whatever direction it's going. It could easily reverse. So I've already talked about this one quite a bit, so we're going to kind of leave this one out. But this was the ascending triangle. I told you about how I usually see this in bullish markets, and it usually means a continuation pattern. However, this is an example of a pattern that can break down the opposite way. So we're going to start looking at some more bilateral patterns here. Okay, so I showed you the ascending triangle, and this is going to be the counterpart in the descending triangle. So this is actually a Bitcoin chart, so it's not going to be as pretty looking as the other chart, unfortunately. Bitcoin charts are extremely volatile, and so they don't usually make the greatest charts to base your TA off of. I personally use the dollar charts because they are more accurate. But for this example, it's going to work just fine. So what we see here is we have a major bull run and a rally, prices rally, and then they reverse and top out. Now, at the halfway point, price starts oscillating in this sideways movement, and it's not really going one way or the other. What you have is, excuse me, what you have is horizontal support, and then you have a series of lower highs being made. Now, I'll mark these lower highs for you. This is a lower high, this is a lower high, and then a lower high. If you haven't seen my video on diagonal support and resistance, I highly recommend you go and watch that because it'll kind of give you an idea of what this means right here as far as lower highs. So these lower highs form, and this shows that the price has found support at the support zone, but prices are getting kind of squeezed tighter and tighter and tighter into this corner of the triangle. Now, this could have went bullish. Remember, this is a bilateral pattern, meaning it's one way or the other. Generally, what you'll see form is it's gonna be more or less a continuation pattern. So in this case, we had a downtrend. It's gonna continue on that downtrend, which is exactly what happens actually. So keep in mind that with these bilateral patterns, there's always that possibility that it could go bullish and actually go against the trend in which you thought it was, but the probabilities of that happening are less likely than it just continuing with what it's doing. So this is an example of a descending triangle. You have flat horizontal support, and then you have lower highs all the way through until price breaks out of that. Now, the way you trade this is going to be the same as the ascending triangle. Once price breaks out of this support zone, then you'd want to be taking your selling actions and then continue with the trend. Now, this is an example of some bilateral patterns. Now, I would like to get into some of my personal favorite patterns inside of crypto. So, we're going to come in here. We'll just stick with the Ethereum chart because it already has one of them that I can see. So, in a major bull market, these are called cup and handle patterns. And they're some of the most bullish patterns that I've found, and they lead to a lot of hype once price breaks out. So you have this is the bull of the cup. You have resistance here. Now, price will rally, and then it'll get stopped out up here at this resistance point. Price will then come down, and it'll round out in the shape of this bull, and then it'll come out, and it'll come and tag previous resistance again. Sometimes it breaks a little higher than that. Sometimes it goes a little bit lower. But all that matters is it's symmetrical in nature. What you want to see with the cup and handle is it generally retraces about half of its value, 3/4 of its value. So generally what you'll see with this pattern is in the handle, it'll retest the depth of the bull. Now, you want it to find support at least half. Any lower than that, it would invalidate the pattern. And so when it tests and finds support at half, that's good. It can also find support up here higher, and that would also be good. However, if it goes too low and it starts retesting clear down and finds support down into here, that's not actually going to be a valid pattern. Once price breaks out of the neckline of this pattern isn't quite as symmetrical, so you'd want to just match and see which one it works best with. In this case, it works better right here. So we see price break out and then land on support here. Now, this would have actually been when you wanted to start taking your buying positions for it was going to continue on that trend. This is another form of a continuation pattern, is the cup and handle. You'll see price start rallying, and then it'll form the cup and handle, and then it'll make a huge move. In this case, price rose. If you were able to catch the retrace, you'd have another 150% move right there. So that's a really big swing as far as price goes. Now, this is one of my favorite patterns to trade due to the fact it doesn't happen very often, but when you do see it, it generally comes and makes very high gains as the trend continues to grow after that. Here would be an example of rounded bottom formation. So we have price rally, price gets topped out, and then we have the retrace. And at the end, at the terminal end of the correction, keep in mind this pattern really only forms at the end of a long sell-off in a bear market. You don't see it at the top. Price doesn't just round out at the top of a market and then kind of fall. That doesn't happen as often. What you'll see it is at the very end of the terminal end of a bear correction. So how I like to trade these is you wait until what you see in a down selling market is a lot of choppiness and downfall. So right here we have choppy, 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 and then sharp falls, sharp price swings, and then choppy, 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 and then sharp price swings. Now, in a rounded bottom formation, you're not going to see much of the price swings at all. In fact, it's going to be more of a stalemate between the bulls and the bears. What you will see is price start to round out in this really symmetrical pattern. Okay? And this happens when the bulls are accumulating. Right now, the sellers are pushing the price down, but now you're starting to see the bulls come in, and they're starting to buy up these dips and these panics in the market. And so what happens is eventually you get to a point where the sellers run out, and they're not able to drag the price down anymore, and then it kind of flatlines. And then once the bulls take over, you'll start to see bullish swings on the opposite side. Now, this is one of my favorite patterns due to the fact it is so easy to spot. It would not take you much you wouldn't have to be that good of a trader to come over here, see that a market was extremely oversold after its rally, considering where it once was, and then you start to see this very symmetrical rounding. Now, that to me is not a hard pattern to spot. And it was one of the first patterns that I really started trading when I got into this and didn't know what the heck I was doing. So this would actually be an example. I want to show you one more example of this pattern. This is a coin. And we'll look at the Bitcoin price because it does it a little bit more accurately. So this is a coin that prints out rounded bottom formations quite frequently. And this is actually what you'd call a fractal pattern. And it repeats the same market cycle, except it just gets exponentially bigger. So you can see price rallies, and then we have a top here, and then a little scoop before the bearish move. Now we can see that rounded bottom happens again. So rounded, rally, top, top, scoop, down. Then we have round, rally, top, top, scoop, and then we have down. And now we're doing the same pattern. We can see this, it just rounds and then creates market cycles. Rounds, creates market cycles. Now we're getting into that second round, and then we'll go into another new market cycle. But this is an example of the rounded bottom formation. I found that with crypto, rounded bottom formations happen a lot on the Bitcoin charts, mainly because on the Bitcoin charts you have a lot of these fractal pattern market cycles that actually come out. And at the end of them, rounded bottom formations are actually quite frequent from what I've noticed. I know Ethereum did one way back in the day before it made its move to all-time highs at 1,200, right around those areas. So these are actually some examples of chart patterns. Now, in other videos, I'll cover more about fractals and things like that, but for now, I just wanted to give you a rough overview on chart patterns and a little bit how to trade them and spot them. Chart patterns pop up quite frequently, so you're going to be able to find them quite often. Like I said, they form on every single time frame, so whether you're a day trader, a week trader, long-term investor, it doesn't matter. You're going to be able to spot these, and it's going to kind of help you know when the end of a correction is for good entries, or when you need to start taking your profits because the market is about to turn around on the opposite end. So I thank you so much for watching this video. If you liked this video, always leave some constructive criticism below. I always love to hear how I can improve these videos and help you guys learn overall. So Please remember to leave a like, comment, subscribe to my channel if you found this helpful, and I'll see you guys in the next one. Peace.